Trading in the markets for the past week and a half or 2 weeks since the election in the United States, one must say it's been a good time. Markets have been very volatile. There's been a clear trend ready to trade. So as far as the agnostic opinions, as it should be agnostic, of the markets go, the election of Donald Trump has been a boon. That is not meant to be a comment, as you all know, on any political commentary. It's simply a fact that the markets have reacted with rather extreme and growing approval to the election of Donald Trump. Now, what you're looking at here is a... Oh, let me interrupt, of course. As usual with my sessions, if anyone has any interesting comments, criticisms, jokes, observations, please type them into the chat. The FX Street Forex live video chat, that is the one that we monitor. And I'll be glad to respond and diverge to discuss whatever the topics you people have interest in. What you're looking at is something I have never seen before, not once. It is the, now I'm sure it's happened before, but I just haven't seen it. It is the probability chart from the Fed. Actually, it's from Bloomberg, based on the Fed funds futures of an interest rate hike at the December 14th meeting, a little less, about 3 weeks from now. There is apparently, in the eyes of interest rate professionals and the markets, no chance that the Fed will not raise rates 1/4 point. And I would agree with that. Wherever you look, there's unanimity. It's a beautiful thing. It's also very rare. And it's also, and we'll talk about this in a minute, a sign of impending changes. However, not perhaps in the Fed funds rate. Now let us refresh ourselves with what happened last year that the Fed is praying will not happen again. Last December, the Fed hiked, first time in 8 years, I think. And what happened? Well, let's take a look at what happened. I'll show you. Okay, what do we got here? Where's my Dow chart? Okay, this is a Dow chart that goes back 2 years. And you can see what happened. It's a little more complicated than this, but we're going to display it this way as such. As we all know, but I'll refresh, the Fed raised rates just about a year ago. And in their attendant materials at that meeting, they projected. They didn't call it a projection. It was merely a dot plot. It was a projection. When you give the markets information from a central bank about what your members think is going to happen over the next year, there is absolutely no chance that the markets will treat it any other way as the Fed projection. Okay, they treated it as the Fed projection. 4 rate increases that would have brought us to 1.25% at the end of this meeting. That clearly is not going to be happening. We'll be at 0.75. Okay? But what happened? Well, we had a huge swoon in all sorts of markets. Equities took a huge dive down to 1550. They're now barking on 1900, 19,000 as I walked into the meeting. What's another thing that happened? And you can say that this is the fault of what the Fed did, but it's really not. Okay, so we have the Fed raising rates here. This is a hike, a devaluation of the yuan. It's a yuan chart. It's yuan, that's CNY, what's called the onshore yuan, the one that's traded in Shanghai. There's an offshore yuan that's traded in Hong Kong that usually is a little more volatile, shall we say. And the rates are usually a little bit higher, whichever way the onshore yuan is going. The offshore yuan just simply goes a little bit further in that direction. It's clear that the events of the Fed events of December had very little to do with the ongoing story of the Chinese yuan. The yuan has essentially been devaluing for 3 years. Not entirely, and the pace has picked up considerably. You can tell, of course, by the slope of the trend channels, what is going on. So this recent acceleration, this is the, shall we call it the Trump effect? We might as well. Is within the bounds of the two channels that went before. So there really hasn't been any change in the attitude and the purposes of the PBOC and the officials in Beijing as to what the yuan needs to do. Okay, let's take another look. Excuse me. We see the same thing with the DXY. We're going to see the same thing with a lot of these currencies and charts that we're looking at here. And what is the theme? The theme of this session is that the recent moves, the post-election or post, 9 o'clock on the 8th, November 8th election moves in most of these markets are continuations of trends that go back almost 3 years. Look at the DXY. The big move up in the DXY took place in 2014. From two-thirds of the year into almost two-thirds of the year into 2014, you could say the last quarter or the last half. That's the big move in DXY. Since then, it's had a range, a wide range, and the little blip here from the election is almost imperceptible. Now, you could say that, yes, you have a height in the DXY going back 13 years. That's true. But the height here was very little different than here, the height here. So this isn't actually an innovation as far as the markets go, as far as what potential levels they're trading with. We can say the same. Let's take a look at a longer view in the Dow. Let's see if I can get a longer view in the Dow. Well, I did not give us a longer view of the Dow. Sometimes when you come in here, you can't always tell exactly which charts you're going to need. Okay, but at any rate, you can see that this move here is not the big move from lower. Oops, this one isn't up there. Sorry about that. Okay. So it's easy. If you run a trend line here, you'll see that the same issue applies here. That you have an acceleration within an already existing trend. Let's take a look at emerging markets. This is the JP Morgan Emerging Markets Currency Fund, currency index actually. Pretty decent move here in the index. The line on all of these charts, the downward pointing, upward pointing arrow, is all November 4th to current date. That's the Friday before to current date. But again, let's take a look at the trend in the JP Morgan. Where's my JP Morgan? Okay, here we go. Here we go, JP Morgan. Going back to 2012, we see the same type of acceleration, not surprisingly, of course, to weakness that we saw with the Chinese yuan. If I inverted this chart, it would look very much like the yuan chart. So we have a long-running trend, and this tiny move down here, a little teeny-weeny thing right there, is the reaction to the American election. So the pro-dollar trend, let's take a look at another one. Let's do the euro. Let's get a better view of the euro. Let's do the euro 3. Okay. This is the euro going back to the inception of the euro. If you're going to talk about trends, you might as well do it as far as possible. So you could say in the grandest macro sense that the trend goes back to the reversal of the peak in June 2008, the famous Trichet peak, and then the famous Trichet decline since then. Now, I mean, 115 to 1 or even 1.2 is a pretty big range. So it's not really a downtrend. But nevertheless, it has all of the attributes of a classical trend in currencies. The peaks are lower, the lows are lower, and the recoveries follow a very standard pattern. So here as well. But let's be in the same time frame that we're looking at some of the other ones, some of the other currency ones. And let's just take this section right here, back to 2012. Let me see if I have a good chart for that. I'm not sure that I do. I do. Okay, cool. So this is the euro in 2000, from 2009 on. Now, here you would have to say that the downward trend in the euro really took place in 2014 and into 2015. Now, what happened back here in 2013? Well, at the end of 2013, we had the former chairman of the, then chairman of the Federal Reserve, Ben Bernanke, start talking about ending quantitative easing. We also had a pretty substantial deterioration in European economics and the involvement in a very large way with the ECB in reducing European interest rates following the path of the Fed with its quantitative easing program. So since the beginning, since the first quarter of 2015, you've had the same thing that you saw in some of the earlier charts, in that the euro has been relatively stable. It's now running to the bottom of this range again. But the spike here, see that spike right there? That's the spike on election day here on the 8th. So the decline, the ascent of the dollar on that event is a relatively minor blip in a very long-running trend. This is what I'm seeing in everything except the yen. The yen is an anomaly, shall we say. But there are reasons for that have to do with domestic Japanese politics and domestic Japanese policy. This again is the Trump reaction, the reaction to the election of Donald Trump in the United States. This is a longer view of the yen, and this is the reaction here. So you can see that it isn't that much. What happened is we went down to 100. Now we all know that as far as the Bank of Japan goes, and the curators of the yen, Donald Trump's election is probably the best thing that could have happened, at least judging by the current reaction of the markets. There is I suppose, a counterfactual. Let us consider what would have happened had Mrs. Clinton won the election, which was possible, certainly, and everyone thought they were. Well, what we would have seen was already priced in. This level right here in the yen, and we can make the same analogy for almost all of the other charts and indices and currencies that we're looking at. Since, actually, I had a discussion with this on television at the beginning of the week. And the reporter, the host of the show, Joe Kernan, CNBC Live in the mornings. Let me finish this and I'll tell you about that. So for all of the markets that we're looking at, this brief period right here before the election is what we would have gotten. There would have been very little sense, I think, that the markets were going to do something different, since it was assumed by everybody, including myself. Although I wrote that I thought Donald Trump had a much greater chance of winning than the markets were giving him credit for, and then the press was giving him credit for, I still thought at the time, and I said it, that you have to go with the polls, that Mrs. Clinton would win. I was wrong, along with everybody else, although perhaps a little less wrong, if that could be the case. But the markets themselves had to naturally price in what they thought would happen. And it would have been very, very difficult. And I don't recall anyone in the market. I'm sure there were, but I can't recall anyone. I know a number of political commentators, not many, but a few, on the right completely, of course, except for Michael Moore. God bless him. Very much a progressive leftist, but a man who knows his people. He comes, I believe, from Michigan and from urban Michigan, perhaps Detroit, but I'm not sure. And he was saying for many weeks before the election that Donald Trump is much stronger than people expect. Not that he wanted him to win, he didn't. And that he could win. He actually predicted that Trump was going to win, which was a very unusual prediction at the time. Anyway, the markets had no part of that. The markets were dealing simply with the straight down the line polling predictions and miscalculations. So we know what the markets, here, take another one. Take a look at the Dow. Bring the Dow back and the DXY. Here's the DXY. This little bip right here, right there at that level, is more or less what the markets thought would happen. Because this down was, this is the 28th to the 4th, and then the 4th to the 7th, and then this spurt up after that. So this area right here is telling you where the markets thought the dollar might go with a Clinton election. Part of that is because had Mrs. Clinton won, it's very likely that the House would have the part of the legislature of the United States, the House would have, oops, sorry, this is not up. Okay, there it is, sorry. So this area right here is telling you that that's where the markets put its projections for the DXY, for the dollar index. It would have been very likely that the House and quite possibly the Senate, considering what happened, would have remained Republican, which would have created a divided government yet again, much as Barack Obama had ever since 2010, and then increasingly since 2014. So you could have expected, just as the markets could have expected, a whole lot less to getting done. Sometimes it seems that markets don't care a lot that what happens as long as something happens. As long as you get some sort of program and movement, because markets can discount anything as long as they know what's going to happen or have a reasonable assumption for what's going to happen. It's when they don't know what's going to happen or when nothing's going to happen that you continue muddling through. So this is the reaction of the DXY. Let's take a look at the Dow. Where's my Dow chart? Here's my Dow chart. Okay, so here we have the Dow. Green line, of course, November 4 to today, which is the 22nd. Big approval, big hand from down there at the Wall Street, the stock exchange. This, all the way through here, the whole summer, September, October, November, the election season. The United States, nobody pays any attention or very little attention except for maybe market people who have to judge what's going to happen, and the endless pontificating classes who don't look very smart or very intelligent right now, of the media. This is the projection right here of a Clinton victory. And it wasn't going anywhere. So you have two competing ideas here. Now let me get a drill down a little bit on a chart. Yeah, here it is, okay. Oh, this is DXY. Not what we want. Hold on, where's my Dow chart? Okay, I think we're gonna have to deal with that chart. Yeah. Okay, apologies, we'll have to use this chart. I didn't have the other chart that I thought. Okay, so this is November 4th over here. This is October 28th right here, the little line right there. This is the 4th. That is the reaction from there down to there. Not a big reaction, but a reaction of the October 28th FBI memo that they're reopening the investigation into Ms. Clinton's emails. November 4th, the Friday before the election, was the second email letter in that chain telling Congress that they found nothing since the 28th to warrant reopening the investigation. So the market then shot back up, okay? This reaction told me one thing. Although I had a discussion with Joe Kernan on the television on Monday about this. I said that the market had mispriced, had not priced in, or had gotten the election wrong. And he said, no, not really. What he thought was simply that the big money was not in and the market was hedging its bets. I think probably both things are true. This is telling you that the market was pricing in a Clinton victory, but that it simply did not think that much given her stated policies and outlooks of a Clinton victory. It did not think that a continuation, essentially, of the current administration's policies, both economic, financial, and otherwise, would be all that great for the market. And so that is why you get both the fall. No, that doesn't quite work. So let's make it here. You get on the diminution of Clinton's chances. The market falls. It doesn't fall a lot, but it falls. It actually fell to a low of since the summer. So we could say 1, 2, 3, 4 months. It fell to a 4. When Clinton's chances after that October 20th memo from the FBI seemed to go down, the market fell. That would tell you that within moderate limits, not excitable limits, the market was looking for both a Clinton victory and it had priced in a Clinton victory. Perhaps it isn't saying that it thought it would be good, and therefore it falls when its chances go down. That's a possibility. And then when you remove that particular problem, the market went back to the same level that it was that it left. It only took off once the Trump victory took place. So Mr. Kernan's point was that really what was going on, it wasn't so much that the market had got it wrong. That means falling as the odds of a Clinton victory go down, but that the market was essentially neutral at that point. I said, of course, well, it may have been neutral, but it did go down over those 9 days during which the chances of Donald Trump winning the election were rising steadily. So that would seem to be at least a moderate judgment on who wins the election. And then once the Trump victory became clear, the market soared at all-time records that we have here. What Mr. Kernan said was that was simply the entry of the big money into the market. And I think that's probably true. Even if at this point back here, any point back here, you thought as a market participant or as a dollar trader or as anyone you like, that the potential policies from a Trump administration will be better for the markets, better for the dollar, on and on and on. If that was your opinion, with apparently at any rate, according to the New York Times, prior to the election, Hillary Clinton had an 80% chance of winning. That was the most astonishing thing to watch that change. They had this live on the internet on one of their websites. It was really a lot of fun to watch it because it was just fascinating to see how they got everything wrong. But at any rate, so even if you thought prior to the election that a Trump election would be good for the dollar, it would be good for the markets, it would be good for the economy, good for spending, all these things, you would be hard pressed to bet on it. And this is Mr. Kernan's point, because the odds at that point were very much, at least the odds as portrayed in our rather badly bruised media here in the United States, we're looking very poor for a Trump election. So there's no point in, even if you thought something might be good, if the odds of it happening were very low, or at least you thought they were low, there's really not much point in betting on it, is there? So nobody did. But the other reaction, I think, which has to be judged along these lines, is the reaction of the futures on election night. They were seeming for most of the evening, for all of the evening, actually, to the open on the Dow, to be passing judgment on a Trump election and a very negative judgment. At some point, the Dow futures were down 800 points before they reversed. By the open of the market, they were only down about 200 points. And that lasted maybe 15 minutes till the market reversed and has been soaring ever since. So we have this very sharp reversal in both market perception, or maybe simply it took the actual election for the markets, because if you, as I just said, if you don't think something's going to happen, how much time are you going to devote to an analysis and to a positioning theory or a potential market position if you don't think it's going to happen? Chances are probably less. If you had a 50-50 chance, you might be giving equal amount of analysis and execution, prior execution analysis, to the two chances. But clearly, we were dealing with a 3-to-1 odds or more. I believe the Huffington Post, who deserves to be brought up, had the odds for Clinton election somewhere around 96%. Clearly, they need to redo their election theorems in the future, and they should probably go talk to people out in the country rather than wherever they're located. Are they located now? I'm not sure where they're located, so I can't talk about that. Okay. Another issue, another currency which had a rather substantial reaction to the American election was the Chinese yuan. Onshore, Shanghai. This is the movement in the Chinese yuan post-election. Pretty substantial move. One way, largely. But as with many of the other things we saw, it fits right in to a long-standing trend in the Chinese yuan, and you have to say within the Chinese economy as well. Now, you can also say that given Mr. Trump's, now President-elect Trump's, focus on trade, particularly on the TPP, the Trans-Pacific Partnership, by name with China. He has called China a currency manipulator more than once. That this reaction is understandable. It's also, as a colleague of mine said, the first opening statement in the negotiations that will be taking place. And that is true as well. But it is also true, more than anything else, that this is a long-standing trend in the yuan. That the trials and tribulations of the Chinese economy have absolutely nothing to do with the election of Donald Trump or the perspective at the point before election of Hillary Clinton. They have a great deal to do with the slowdown of world growth, of the overinvestment in the Chinese manufacturing sector, in a number of very long-standing macro trends within the Chinese economy. Okay. Let us now consider the future. Oh, let me just show you. I showed you this one again, but I just want to show you. This is the, to remind you again that this is the JP Morgan emerging markets. And it's the reverse as far as the graph goes of the Chinese yuan, except for this right here. This is actually a curious differentiation between the two charts. For most of 2016, there hasn't been the kind of substantial move in this index that you saw specifically in the Chinese yuan. Okay. And just one more. This is the odd man out for obvious reasons. This is the sterling. But we're seeing the same type of trend. This is, of course, the Brexit vote. Now, I want to alert everyone. It's not getting as much coverage as the Brexit vote, but there is a hugely, even more so than the Brexit vote in. It's funny, before the election, I was getting emails from some of my Italian relatives advising me which way I should vote in the American election. You can make your own guesses on that. So now I have a chance to go back to them and make some comments. We're going to go see them this summer, actually, with the girls. Make some sort of comment about this referendum. What is happening? It is on December 6th. It is in 2 weeks. And it is not getting the kind of coverage here in the United States. I mean, of course, it's not going to. Here in the United States, we're still on the election. The media hasn't changed its mind. Of course, the media dislikes Donald Trump rather intensely. And so the coverage has been rather one-sided. You learn to live with this kind of stuff. It's not that unusual. In Europe, you tend to, the news outlets tend to have a decided and very well-known political slant, and everybody discounts it. Here in the United States, we've had this sort of fantasy, really, that the media's role is objective, and it's really not true. It's really never been true. So we kind of think there's something wrong when the media, in its news and other stories, takes obvious sides, and that's pretty standard. And I think probably the European model is a little more, however it evolved, a little more sensible, because it's going to be there anyway. And everyone is, news is written by people have points of view. At any rate, this is the sterling over the past year. And of course, you have the same type of consideration. that the trend predates. I don't think I have a longer term. Your sterling chart. I do not, but you can get the idea from this. Oh, yes, you do. Here we go. Okay, this is specifically a chart with the UK base rate and the Fed funds rate. And it's clear that the downtrend in the euro, in the sterling, goes back, and this is a perfect channel on the way down, goes back to the middle of 2014, just like the euro. There isn't, this election, although it looks to be a large event in the markets, and for equities, I think it is. But for currencies, it is not. The trends within which we have seen the moves of the past 2 weeks in the currencies are within long-established trends determined by other macro and interest rate policy factors. And one of them is certainly here, for the sterling at least. And I haven't gone into too much because this is specifically about the dollar. But the decline here is related more to the Brexit vote, because this is pretty stable right here, and the drop in the UK interest rates, as you would expect. And let's take one more look before I talk about some of the political ramifications and what's likely to happen, because this is very much going to affect the markets, because the markets have made a political judgment, or they've made a macro judgment based on politics. And this is going to be the next topic and the last topic we talk about. The election of Donald Trump and the unified political base that the Republicans have, and they have a pretty serious agenda about what to do, are judged by the markets as positive. You can disagree all that you want with the election of Mr. Trump, surprising as it is. But you cannot gainsay, you can't go against the market judgment. I'm not saying you can't disagree with it, but you can't disagree with the idea that from dollar strength and equity strength and rising interest rates, we'll look at that in a second, the markets, currencies, equities, and credit are telling you that the view of the markets, the participants in the markets, that this political development is going to benefit the economy. That's what it's telling you. You don't have to agree with it, but you have to acknowledge it. Otherwise, you're short the dollar, short the equities, and long the bonds, and you're going to get killed, because that's not the way the movement is going. So the interest rate probabilities are rising, okay? Probability of a cut, 0. Probability of a hike at the next meeting, very high, 100%, can't be any higher. So that means we're going to get 75. So as you move out, all of these rates are rising. What will be most interesting for the dollar, not so much for equities, but for the dollar, will be the projection materials that come out with the December 14th meeting. Remember last year, the Fed projected 4 increases in 2016. If they do raise rates as expected on the 14th, we will have had 1. Those are not very good odds. You would think the Fed would know better. But the Fed, we should all remember, is absolutely no better, and sometimes a good deal worse, than predicting what will happen than anybody else in particular, or the market as a whole. How do I know that? Here, let me show you. Okay, let me see if I can get which is the longest chart here. Okay. This, well, let's do the other one first. So let's do this one first. Okay. DXY, white line. 10-year generic yield, green line. Purple line, Fed funds rate. You kind of ignore the purple line on the Fed funds rate. Okay, so December 15, last year, or December 2015, the Fed raises rates a quarter. Everybody goes, ah, markets go crazy. In their projections, they say 4 more rate increases during the year. Did the market believe it? Well, the market believed it for for less than a month. As soon as the Chinese yuan started going up for the second time, went up in August and went up in December, equities whoosh, collapsed. You're not going to see that here. The DXY went down, and the 10-year yield went down. In fact, the 10-year yield went from here, which is about 2.2, down to here, to July. Notwithstanding the initial Fed projection for increases, the markets were right. The Fed was wrong. The Fed's own projections didn't come remotely close to depicting what would actually happen. The credit markets did. So now we are approximately back to the same level, a little bit over, where we were in January, just before the fall. My guess is this. All of the factors for a Fed increase are in place. I mean, I don't think anything could happen right now between now and December 14th. We have one more major piece of news. We have the non-farm payrolls the first week in December. If those come in at negative 500,000, the Fed might not hike. But anything north of that, they probably will. Anything within the range of expectation, from very negative to very positive for that particular non-farm payrolls employment situation report, will not prevent the Fed from raising rates. They are so far backed into the corner, they'd have to go through the wall behind them to get out of this particular corner without raising rates. So you can rest assured that's going to happen, unless somebody major declares war on somebody else. I don't really know. That will happen at the December 14th meeting. But the market is not telling you, despite this very rapid increase here, okay? Again, this is getting back to here. This is not telling you that the market is starting to price in 4 or 3 or even 2 increases in 2017. Not yet, at any rate. Now, I heard an interesting interview on the way in on surveillance. It was Jim Paulson, I think, who is a big hedge fund manager, very successful. And he was saying, and I've made the argument both ways, you can't really tell yet, that even if the Fed does continue to increase rates, perhaps even say 2 or 3 times in 2017, that the potential drag on the economy from that increase, of course, classical economics, higher rates, lower economic activity, will be displaced by the increase in business confidence at a normalizing rate environment. That you will no longer see businesses sitting on their cash and their hands instead of investing. And don't forget, business investment is one of the things that produces, and maybe the main thing that produces increases in productivity. Without increases in productivity, the economy, at least the share to divide up, does not get any bigger. Workers don't end up with increased wages unless there are also increases in productivity. So business investment, the lack of business investment over the past couple of years has been one of the real drags, both on the economic growth, because it adds specifically to the economic bottom line, to the macro growth numbers, but also in the sense that productivity has stalled. People in businesses invest in productivity and in capital spending to either make more goods just on an absolute level or to improve both the quality and the productivity required for the groups that are made. It means make them with less resources, or make each worker each worker to produce more goods. So his point was that the permanent crisis institution created by the Fed of zero rates is far more damaging to business confidence, since one, they're wondering what the Fed knows that they don't know, keeping rates at a crisis level for all this time. And two, well, we all know when they're going to go up, but how far and when, we don't know. Both things make it difficult or act as a drag on investment decisions. Someone wants to build a new plant, is going to say, well, if the Fed thinks rates still need to be at 0.5%, a historically low rate, even now, 2016, 7 years after the end of the recession, shouldn't we be worried too? If there's a crisis policy, there's a crisis policy for a reason. So Mr. Paulson's point was that this is damaging to confidence, and I agree with this, and I've said this many times, and that without confidence and the ability and the confidence to take risk, you don't spend. You sit on your cash. You take the safe route. Now, it's not true across the economy, of course, but on all of the middle level marginal things which might happen, it certainly has an effect. The second, of course, is that as you plan your project, you're going to be funding it over time with borrowed money, and you don't know how much to factor in for interest costs. Okay, so those are the two issues. That a normalization, even though in sort of just the equation reaction, higher rates will be worse for growth. It's quite possible and quite believable that higher rates will actually be conducive to growth for the reasons I just said. Okay, so let's deal with one more topic here, and that will be the likely initial accomplishments of a Trump administration. What can we look for? The easiest thing and the first thing we can look for, of course, will matter somewhat, but not that much, because the market's already priced some of this in. You can tell by looking at the yuan, peso, and emerging markets levels, is the Trump administration's approach to international trade. Mr. Trump has said that he's not an isolationist, that what he wants is fairer trade deals. Nobody knows quite what that means. But nevertheless, there will be, and there are accessible to executive orders, many of the trade arrangements that have taken place in the past couple of years have taken place with simply under the executive order rubric. And Mr. Trump and his people can easily reverse that. I believe Mr. Trump said today that the U.S. will withdraw from the TPP, the Trans-Pacific Partnership, on day one of his administration. So when it comes to what is going to be enacted, first things will be the easiest things to do. Executive orders, either the immigration, trade, other items that the Trump administration disagrees with, will be simply negated by the Trump administration. The big one with that will be the TPP, but there will be some issues, of course, with labor and items from the southern border where there's lots of human trafficking, as they call it. That's the first thing, and that'll get done relatively easy. I read an analysis of how the Trump administration can change immigration policy, and it's actually very easy. Relatively speaking, they don't have to get anything through Congress. So if a restriction or a much tighter southern border, however the markets view that, I don't think the markets are going to be terribly affected by that. Certain sectors might. Sectors that use immigrant labor might be affected by that. But as a whole, I don't think that particular issue will deal with it very well. Second thing, and this becomes much more complicated, are things that are relatively easy to negate, but much more difficult to replace. Certainly the healthcare program called Obamacare falls under that category. The Republicans can relatively easily, with a number of procedural maneuvers, repeal, if they choose, Obamacare by the same method as called budget reconciliation that does not require 60 votes in the Senate to repeal the entire bill. They can do it. This is the second order of developments. How will the markets view this? Let's say they do that. And it will be more difficult for them to replace it with something else, but I think less difficult than they think, because if they replace it, if they withdraw it, negate it, there are a number of between 5 and 8 Democratic senators up for re-election in 2 years who are from states that Trump won this past election, either by huge margins or by much smaller margins. Their seats are very much in play. Obamacare is not a popular program. It's far less popular in those states whose senators I just mentioned. So there's a very good chance that if the administration does repeal the Obamacare health law, that the Democrats will be under enormous pressure to help them replace it with something, even if they don't agree with the philosophical, economic, and financial structure. There'll be a number of senators open to very substantial Republican and Trump pressure to help them put something in its place. As far as its mandates, its rules, and its costs, one must assume, and the markets are assuming, that a replacement for Obamacare will be more business friendly, will be less costly both for businesses and for the economy as a whole. A corner piece, one is assuming, of any Republican plan will be choice, perhaps deregulating the national market in healthcare, and this will, both lower people's costs, thereby providing more money for the economy. So that those two policies there are certainly the Obamacare policy in general will be considered and has been considered. These are all things that are going into the pricing that you're looking at on the screen here. Another area of potential movement by the Trump administration would be tax reform. That there will be a cut in taxes. This is the tried and somewhat true method for the Republicans of juicing the economy. Now, none of this changes the fact that the economy is running into its 8th year of a pretty tepid recovery. Sooner or later, there's going to be a trigger for a recession. Nevertheless, any kind of fiscal spending plan, be it infrastructure or anything else, will also pour, depending on how it's done, of course, put money back into the economy that one must assume will be used to support growth. Okay, last one. The Trump administration, or Donald Trump himself, have said that they will roll back all sorts of regulations. The Obama administration has been a great creator and distributor and promulgator of regulations. They're very much on the side as far as their concept of government goes. The government's role is to regulate, basically regulate everything and tax as much as possible. They've been prevented somewhat on the tax side of that since 2010 by the election of control of the House, which should own the Republicans. But again, a reduction in regulation, whatever you think about it in particular, whether it's the right thing to do or not, or whether I think it's the right thing to do about it, will largely be viewed by business and the markets as a plus. So of the things that we're looking at for a Trump administration, we're looking at the reversal of executive orders, the probable removal and replacement of Obamacare, some type of large spending package, and a reduction in regulations. When you actually analyze those, as nebulous, as unformed as they are, the potential policy programs the first 6 months of a Trump administration, you can see why markets suddenly got religion. And they decided that this particular program, even though they seem to be of a positive view of Mrs. Clinton, Hillary Clinton before, it was moderate. It was limited. You can look, because if the markets really thought that a Clinton administration would have been good, then what would you see? Let's take a look. Where's my Dow chart? And then we'll end on that note. If that was really the case, the markets thought that a Clinton administration was going to be a great boon for the economy and equities, you don't find it on the chart. All through this period here and increasing right up to here, the odds of Hillary Clinton, excuse me, winning the election were rising until, as I said, just before the election, various news, and I use that in quotes, outlets were predicting a 90% chance. Yet you essentially see no reaction in the markets. So it is, in my mind, true, despite Mr. Kernan's opinion, and he's a very smart guy and I respect his opinion a great deal, that the markets did not view the a potential Clinton victory as a great plus. A small plus, perhaps, as in continuity, and you see that depicted by that fall from 28 to 4, but not a huge plus. Okay, folks, we've run over a little bit. I thank you all very much for attending. One other caveat. When you have such unanimity of markets and such very aggressive pricing in of an economic policy, it's time to make sure that you're looking at your rearview mirror all the time. Anytime everybody agrees in the markets one way things going to happen is when the odds, in my mind, of it's happening start to go down. Okay. I thank you all very much for attending. This webinar will be posted, of course, as always, on FX Street. We will also be posting them shortly on our new website. We're going to organize them by topic so that you can, if you're so inclined, go back and listen to the discussions on these topics. I'll put my email address up there, and Adinda will send it out. If you have any questions, comments, or anything else, please send them to me, and I will be happy to respond. I thank you all for attending, and I wish everyone a good day. Take care.